Ladies and gentlemen, this one is going to be another panel discussion. The topic that we are going to be discussing right now is emerging real estate finance and funding scenario. I'll repeat the topic for you all once again. It's emerging real estate finance and funding scenario. एक बार इन लोग के लिए भी बजाएं हम लोग जोर से ताली प्लीज. तब से they are working very hard to get the tables and chairs sorted for all of us so that we can move forward quickly. Thank you so much. Thank you so much. हो गया perfect है कि नहीं? हो गया ना? हाँ. See, appreciation motivates everybody. Everybody want to get the job perfectly done. Thank you. है perfect है perfect है. सिर्फ pencil गिर गया वहाँ पे. Yeah. Thank you. All right, so quickly introducing the topic. This is going to be about emerging real estate finance and funding scenario. I have brief introductions about our respected moderator and our honorable speakers. I'll be first reading them all, and after that I'll be requesting all of you to join me on stage together after the introductions are done. Thank you. To moderate this session, ladies and gentlemen, we have with us the honorable presence of Rahul Raj Gogna, Senior Director and Head Capital Markets, Bangalore, JLL, India. Mr. Rahul is responsible for providing investment and financial structuring advice to JLL clients in the geography. With over 18 years of experience in real estate, investments, development and asset management, Rahul ji has worked in the US and India real estate market, having executed 100 million US dollars of structured financing transactions and development deals with a turnover of more than 250 million US dollars across all sorts of asset classes. He specializes in assisting clients with their market entry and investment strategies, of course. I'll now be talking about our honorable speakers. I'll be talking about them in alphabetical order. Thank you so much. Give it up for sir, please. He's joined us over here now. Thank you so much for your time. I'll be reading out the introductions of all the speakers, and I'll be requesting all the speakers to come together after the introductions are done. So please take your seats, sir. Thank you. Today we have with us Mr. Anuj Kapoor, who's the founder and partner of Upwisery. Anuj ji is a seasoned capital market and investment professional having credentials for closing 100 plus transactions totaling more than USD 1.5 billion in his entire career. With over 22 years of experience, Anuj ji has rich expertise in mergers and acquisitions, capital raising, investment management, transaction structuring and growth advisory. Anuj ji has advised global multinationals such as Novartis, AG, Pfizer, Inc., Eisai, Co. Limited, Roche, Bill and Melinda Gates Foundation, Albany Molecular Research, Georgia Tech University on a variety of advisory engagements. We also have with us today Lakshmipathi Chockalingam, Senior Managing Partner, ASK Property Fund. Thank you so much, sir. Please give it up for him loudly. Lakshmipathi ji joined ASK in the year 2009 and is a vital core team member. He leads fundraising, deployment and investment management, beg your pardon, of real estate funds in South India, currently overseeing a portfolio of 6 billion Indian rupees, which is equivalent to about 95 million US dollars across 8 million square feet, including over 6,700 residential units in South India. My goodness, some really big numbers, huh? With over 2 decades of experience, he previously worked with ICICI Bank, specializing in real estate and mortgages, and he also holds a BSc degree from Loyola College in Chennai. Please give it up for him once again, Lakshmipathi ji. Thank you. We also have with us today Navin Dhanuka, who is the founder and CEO Altern Capital and also the co-founder of Addis Uniturn RE Solutions Private Limited. Please give it up for Navin ji, everybody, ladies and gentlemen. He has over 20 years of experience in RE investments pan-India. He has managed investments of more than $2 billion across 100 plus transactions across the capital stack of debt, mezzanine and equity investments. In his entrepreneurial venture, Addis Uniturn, he has closed more than 20 transactions within a short span of 6 months. Beyond his focus on real estate, he also has a keen eye for equity investments and has been an angel investor in multiple startup ventures as well. Wonderful stuff, truly backing the future generation. Thank you so much, sir. And we also have with us today Sudarshan Lodha, who's the co-founder and CEO at Strata. Sudarshan ji, please give it up for him, ladies and gentlemen. Thank you so much, sir. Mr. Sudarshan co-founded Strata, an investment platform offering premium commercial real estate, enabling investments accessible to everyone. Strata is a tech-enabled fractional real estate investment platform, and Sudarshan ji leads the company's strategic roadmap. With over a decade of experience, he has been closely involved in several PE and VC transactions, representing over 1.4 billion in investments. As much as the number sounds scary and huge, it actually is. Please give it up for them, all of them together. Please make some noise. Thank you. And, the stage is set. The panel is ready. Please, over to you all. Thank you.
Well, thanks a lot. Thank you for the introduction. Good afternoon, everybody. I hope everybody had a nice lunch and strong coffee after that, I hope, because you're going to get a lot of nuggets of wisdom from our panelists here today. I'm sure you'll be eager. So without further ado, let me just turn to our panelists. So if the panelists agree, I'd like to sort of structure this transaction more, let us say, starting from the macro view and narrowing it down to India-specific scenarios. So with that, my first question, maybe to Pati and then followed by that to Anuj, is that we're seeing a lot of geographical upheaval, outside geopolitical stuff that is happening in the world all over. A few pointers being Fed rates are being cut or have been cut in the past few months. Eurozone is also following. Of course, in the Eurozone, because of the conflict that is there to the eastern side, you have a little bit of a retrenchment. But on the other hand, you, of course, are realizing that central banks all over are seeing that inflation is a little bit more under control and therefore economy needs to go better. Election results in the US have happened. We have a clear, decisive mandate, and effects of that are already kind of resonating in the markets all over. Then, of course, you have the China strategy, China plus one strategy, and so on. So, given all of these developments that are there in the market or are unraveling world over, how do you think this will impact the capital flow into India as such?
Quite a long question, but see, India in 2024, particularly in the terms of real estate, is not what it used to be in 20s, say 2000s. Okay, we have moved a long, long away. These structural and regulatory reforms in multiple ways, including introduction of IBC, introduction of RERA, GST part, the structural tax reforms on the home buyers side, the NBFC collapse, what we had gone through, this entire industry has led into consolidation. The weaker players have moved away. Okay, that's a clear story. Today, the lenders, the home buyers, and the investor to the funds are very comfortable with the real estate as a sector in India. You are dealing with, in a broader, very well-framed regulatory framework. If the project goes on a default, the home buyers has an access to complete the project legally. Similarly, the lenders, they don't have to go through the erstwhile long litigation process. Today you have insolvency to complete the project and get their money faster than what it used to be earlier. Okay, so the real estate sector is much reformed and much strategically risk mitigated compared to what it was in the past. What you have to also bear in mind is, in the last 2 decades, the domestic economy in terms of investments have dramatically improved. Today, for example, Ukraine-Russia war has not significantly impacted Indian economy at all. Okay, even the Israel war has not impacted at all, right? You may have a couple of days of blips on the equity markets, but for real estate sector, the domestic fundraising is very strong. The foreign institutions' money also coming. Typically in our fundraise, 40% of the money comes from offshore. So that continues to increase. Okay, it used to be earlier 20-25%, now it has gone as high as 40-45%. People are understanding the Indian real estate very well. Yes, we are not insulated from the global impacts if some black swan event happens. But we have resilience to overcome those black swan events. For example, today, if interest rates goes higher, Are we provisioned in our buying? If you see your home buying, it is at all-time best levels at 8.75 home loan interest. Instead of 8.75, the rate of interest may go to 9.25. But if you see the history of home loans, people typically close their home loan in 7 to 8 years time. Average home loan is only 7 to 8 years. So we are a matured economy in terms of home loan borrowing. Our, our NPAs are far lower compared to any other markets. It's less than 1% actually. So we are a very strong market. We have built strong factors to overcome the global issues. We are quite equipped to handle that.
Fair enough. There is a little bit of a conflicting view, though, that I hear, and maybe I would like to take your take, Anuj, is that, banks, on the other hand, while, of course, the fund industry, the AIFs and so on are, like Pati said, there is a good capital inflow that is there. But the banks in India are sort of seeing that high loan to deposit ratio, unraveling. Now, like Pati said, we are a mature market in loans as far as home loans are concerned or any other kinds are concerned. But banks themselves feeling that crunch, do you think they will hold back in supporting this any further going down?
Hi, good afternoon, everyone. I have two different things to cover here. One is obviously the previous question.
You can answer that initial question.
So specifically on bank side, I think what we are seeing on the domestic market front, there's a lot of liquidity. Banks had gone through, all the financial institutions had gone through a very bad patch few years back, but I think everybody's balance sheet is very strong today. And I don't have to talk about in generic. If you see just the numbers of how the bank credit into real estate, I think if I recollect the numbers well, 5 years back, the bank credit to real estate was somewhere in the range of 12 to 13 lakh crores. As of March of this year, it was 35 lakh crore. So at a base of say 25 lakh crore, the market is growing on an average CAGR of about 18-19%. That's a huge, growth in absolute terms, which is a very clear indicator that there is enough liquidity at financial institutions level, and there is a very clear penetration of, home loans and even the developer finance, which is happening to the real estate sector. Obviously, with the market doing very well, while the home loans are, getting disbursed higher number, but developer finance side, the wholesale lending book is actually shrinking down. As much as the institutions are trying to give more to developers, the developers are repaying it much faster. So I think that is a cyclical trend which you'll keep seeing all the time. Coming to your earlier question about the global markets changes which impacts on the real estate here. So I think the bigger challenge at a macro level what we have is, given the size of our market and the potential it offers, our number of our actual quantum of capital flow is very disproportionate. I think we technically can absorb far more capital from global markets than what we are doing. And it is very clearly reflective on certain statistics. If you see, we as a country, we don't even figure among the top 10 capital absorbers when it comes to real estate in the world. Even a country like Spain, takes more global capital than as India put together. Right? We are not even on top. So in the last 12 months, if you see, the global capital which got invested in real estate, India's share of that is less than 3%. So while the opportunity side, we are very big, we will do massive numbers as we go forward, but the current base is very less. And I think I agree with what Pati was saying. The history of very different kind of market dynamics which was there is now to a large extent got corrected with structural changes on transparency and a lot of institutional structure being brought in. And that is now slowly going to attract a lot of institutional capital to India. Why it has not happened in last 3 years is because of the global dynamics market, which is what you were referring. When US in the start of 2022 was at 0.25 basis at an interest rate, they were about 5% 6 months back.
Yeah, the highest in
Right.
the
So
start of the year.
when you see that kind of a sudden increase, combined with the fact that their own domestic market started reeling, like markets like New York or SFO, if you see, they were running at a commercial office vacancy of 23, 25, 26%. So the big, large institutional investors were having a lot of trouble at their end there itself. So it is an approach which they went by a very cautious, thing, not something that they were deploying capital left, right, and center globally. But I feel that we have a very strong base today. Over the next 10 years, what the kind of capital flow which we are going to see, we would have not seen in the last 30 years also. That's my take on the global
Understood.
capital flow.
No, fair enough. Both, I think Pati and Anuj are pretty much aligned. And that also shows in data, I think, Navin. I'm going to come to you. We have seen in this year itself that total investments in terms of actual transactions that have happened is crossed about $8 billion in India. And this is actually about a 12 to 14% increase over last year. And these are real deals that have happened. And interestingly enough, 40% is domestic out of this money. So, and of course, not to mention the AIFs are raising money. There is a huge inflow that is happening. So Navin, you and maybe, of course, Sudarshan also, when you go to your investors for either raising capital or making them understand the scenario going forward, because I'm sure they are looking at you and keep giving their money on your credibility and your track record. What are their responses to all of this? How are they now more certain and hence more domestic capital?
Good afternoon, everyone. So, a few of the things just to mention, and I'm sorry I'm digressing a bit before coming exactly to this question. So, though our domestic strength remains very, very proven, and we can understand that from the amount of liquidity, as Anuj was talking about, the number of oversubscriptions each IPO is happening. But at the same time, we are having the same, you were talking about the deposit to loan. Why is that happening? That is the question we need to answer. It is happening because today with the, the positiveness in the domestic or the confidence in the domestic economy, people are not keen on going into that 5-6% FDs and more interested in taking that extra risk. And they believe that the world is going to grow, India is the bright spot. And thus, if I get around 10-15% on a month-to-month basis, why I'm putting on that 5%, 6%. So they're taking that extra risk. If the liquidity was not there, the oversubscriptions wouldn't be happening. Also, probably because of all the so-called scams or the credibility issues out there, probably there's a little less faith in those deposits now, and people are looking either at those IPOs, are looking at, and you see the growth of a lot of alternate investment opportunities, like we have Sudarshan here, who has got Strata, PropShare. You see a lot of other innovative products which are now coming in the country, and people are more inclined with the education moving up, with the middle class growing up. So they are becoming a little more, the new generation is, or the Gen Zs as I call them, a little more risk-taking, and they don't want to be only sticking to the old traditional products, and they are looking at more innovative products. So that is where I think the challenge is happening, and government has to, some way or the other, has to.
So I think there is,
stand up to that.
if I understand correctly, what you're trying to say also is that information emittance out into the market is much more as compared to earlier.
Much more.
Transparency, like Pati mentioned, is much more.
Yeah.
If I can add to give a one word to his point, what we are actually going to see the big trend in this is it's nothing but a financialization of real estate. Earlier, as investors, we had only hard assets to invest in. Now, in the last 10 years, we have instruments which are backed by real estate where we can invest in. So it's actually nothing but the financialization of real estate is going to happen, and which is what is unique and new what people are investing in.
Sudarshan, your take.
No, so bang on to this. I mean, when everybody asks what do you do, I say I simply financialize real estate, right? So we tokenize, we break it down into units, whatever you call it. And, adding to Navin's point, typically what we've seen are investors who we reach out to, uh, they always wanted to participate into something like this. I'm not talking about the large funds who have raised capital. I'm not talking about a Motilal or a Kotak, etc. Because their ticket sizes are also about 1 crore, 5 crore, whatever their ticket size is. There's a very large audience which has 10 lakhs to 1 crore of a money and wants to put money. But today, Pati was mentioning this point earlier, saying that none of the AFs have actually returned money on time or probably even returned the exact returns they were promising as such. So he's saying I would rather take an informed decision rather than a blind pool investment also, right? So that has now a change to what Anuj was trying to mention of financialization. People are now aware. There's a whole lot of transparency around it. But since COVID, there's a massive change, especially in the age of 28 to 40. And that is the new India which is coming up. There is a significant amount of financial literacy in this segment now, which was not the case before. You go back, even now to some extent, we very lack financial literacy. We are very, very illiterate from a financial standpoint as India's standpoint. I mean, one of the MPs from Karnataka mentioned that 11, 12 should insist on doing something like that. But that has now caught up, and hence you see a lot of Fin influencers, and SEBI eventually came back because a lot of XYZ things were happening around it. But that has led to a lot of investors to understand that FD is not for you. If you're 25 to 30, 40 maybe, you could take that risk, go out and try riskier products, try crypto, try XYZ, whatever it is for that matter, but you can always earn that money. But try burning your hands, right? So that is one thing which we are seeing as a trajectory in general. And we've gone to that, at least from our standpoint, and I'll speak, and I'm sure even Navin over here, as we've gone to a separate pool of money which always wanted to invest but did not have a channel through which they could invest their capital into, right? So that's what we're
And of course, it's got to do with the, like I mentioned one last point previously, the credibility of the fund manager, the track record.
That will always remain the priority, right? Because you're always giving it to the person. And if that track record is not there, ASK, if you see, they have a track record of, almost now 17, 18 years. Time and again, they have done that. They have proven themselves. So that will always be the most important thing. That's the same thing a fund looks when they are putting the money with a developer, right? So how can the formula change? That will remain always. The fund manager is the most important thing. And what they have done, the investments and more importantly, the exits. That has always remained the most important.
I'll probably add one more point. What has also changed since COVID as such is we're now in a new India where the regulator is not reactive but proactive. So regulators coming forward and saying, okay, we understand industry wants to do this. We'll roll out a consultation paper first and create a new regulations. I mean, if you just go out on SEBI's website in general and see the amount of consultation papers they've rolled out in the last 2 years, it's probably more than what they've done in 10 years collectively is what they've done in just 1.5 years, right? So they've come back, backed companies, backed innovations. They run a sandbox themselves. RBI ran a sandbox where if you're a new innovative company, you come forward. What you see of video KYC today is a product of the RBI sandbox, right? And it became a reality where we're like, oh, video K through, you can open your bank account, right? But it all happened because the regulator, or like I quote it as the new India, is now very, very proactive and not reactive. Okay, let a scam happen or let it become too big. And then probably I'll come back like a Sahara and then say, no, you can't do this any further, right? So they're trying to catch these.
Sometimes over proactive.
Sometimes over proactive, and I'm sure a regulator has its own approach and thought process, right?
No. So, of course, clearly, like you mentioned and the others, that the private capital, private credit is all increasing. But then, Pati, like we were discussing a while back, also backstage, as I understand, of course, in real estate, the fund sources are what? Banks, NBFCs, and finally, PE funds like yours. And, sort of the spreads of, what essentially the cost of that money is to the developer is anywhere between, let us say, about a 9.5 to as high as about 24, 25% also. From the perspective of the retail investor, who has, like you just said, become much more informed, knows the market, has a lot of products to compare with, you know, how is he responding to you when you are, let us say, in the fundraising mode whenever, in terms of comparison of what returns you will give him versus what a stock market has been giving, at least for the last 3 years, if not more?
Just to give you a flavor, our average ticket size in any fund, what we do is approximately 8 to 9 crores. So if I leave the large tickets, above 5 crores out and look at the retail customers, which is 1 to 5 crore, because AIF now minimum investment is 1 crore. When we meet any of these fund investors, whether it is a 1 crore investor or a 100 crore investor, they look at two important things. First, alignment of the fund manager to the fund. Second, the strategies alignment to their expectations. You can't go and sell your product to a family office whose mandate is to put money only on a debt instruments. Okay. So the return expectations today, for me, the biggest challenges when I go for a fundraise is two. Me, myself as a fund manager. Second is the market expectations. The first challenge what I have to face is the investors' experience with the other real estate funds, which I was mentioning offline when we were discussing, that today the track record of the fund managers in real estate private equity is not completely established. You do not have large scale of exit track records other than 1 or 2 people actually. Okay, very few people carry the exit track records. But unfortunately, the funds have been raised by multiple people. Like the consolidation happening at the developer side, the fund managers also getting consolidated. Today, how many fund managers are there? Actively 5, 6, 7. All put together, AFs is roughly 3 lakh crores. Okay, and now look at the annual requirement. The real estate requirement is about anywhere between 70,000 to 1 lakh crores. Okay, and the number of AFs today in the market all put together will be 15 to 20,000 crore. Bank credit to real estate sector is approximately 17%. So there is a huge, and banks cannot fund for land acquisition. That's only a working capital. So today the domestic investors are looking for alignment of the fund manager to the fund, their strategy, whether it deals with the return expectations. Today with the equity markets going on, and they are more resilient and they are more matured to stay in the market even when it corrects 10 to 15%, because they started to look at that as an opportunity. So they don't get excited at 20-21% pre-tax IRR. Because if you see net of tax, all expenses in hand is about 10 to 11%. So we are dealing with what? We are comparing with debt income returns. So today the alternate investment asset class is started to compete with debt instruments. We are saying debt instrument is 5% pre-tax, whereas this product is 15% pre-tax. So that's the play what is happening. More and more all the fund houses are moving towards this play, where the gap is on the funding, which is huge, as rightly put by Anuj earlier. We can absorb at least 10 times of the money what is available today. But there is absolutely money is not available. Today for me, deployment is not an issue at all. Last year I deployed 1800 crore. Okay, and today I have a signed term sheets worth 2000 crores. Okay, so problem is not in the deployment, problem is on the fundraise. So fund managers, for example, I'm a founding member for 16 years. The core team has not changed for 16 years. So people look for that. People are okay. Investors are okay if your investment goes bad. They understand that investment can go bad. But whether that investment has gone bad because of the market or because of the fund manager. If it's because of the market, they are willing to accept that risk. If it's because of the market, then they are looking at the fund manager's ability to resolve that asset. How did the fund manager shown ways to resolve that asset? What are these extra things he has done? Okay, everybody uses, the best of the lawyers to write the agreements, but still get into litigation. Litigation will not solve your exit. with particularly new SEBI guidelines on AFs that you cannot extend the tenor beyond the tenor agreed and it has to move to dissolution period, it is a very complicated one for the fund managers. Fund managers' ownership is much more higher. Their accountability is much more higher. So investors are very strong. They are very right. Today they have liquidity very high in the equity markets and the debt instruments. You are going to position a product which does not come with a high liquidity and with a longer tenor. So it's a very tough sale. So
It is tough. So, and hence, I was just trying to understand, how is it that you are still able to convince
we are
people?
consistently able to raise funds significantly from domestic investors because of only three things: our alignment to the fund, our strategy to the investors' returns expectations, and our track record. If you start establishing these three things and start differentiating, never go, as a fund manager, none of my team members go to a client meeting to sell the product. We go there only to give real estate perspective. To sell, we have the RMs who's managing that investor relationships will take care. The investor is looking for the fund manager's ability to, whether he is understanding the real estate. That's the first thing he wants, their confidence. So alignment, investment strategy, and the track record. If you consistently establish that, it is very possible to raise fundraise.
Navin, your take? I know you are, of course, you have been doing this and now you are doing it on your own also. So what are you seeing?
So I was always lucky. I was working with all the big, large, Piramal and Altern. So I was more always on the deployment and exit side. This is the first time I've gone into the fundraise and facing the challenges of the same. But see, there are, in addition to what Mr. Pati and Anuj were saying, let's look at a bit of history. 20-25 years ago, banks used to fund for land. If we look at 2010 to 2020 roughly, if we look at the top 10 NBFCs, if they would have done 500,000 crores into real estate, directly to indirectly about 200 to 250,000 crores had gone towards land one way or the other. We are saying we are a growing market. Population is increasing, we are not controlling it at all. And so is the economy. We are fifth, we are third on the basis of PPP, and there is strong, confidence that the country is growing and the wealth is growing. When that confidence is there, automatically you take that capital decisions of buying homes. So we see that across, and there are enough data rather than talking about it, whether it is Bangalore to Bombay to NCR, everyone have been growing seriously. Now, there are two main raw materials of real estate, land and money. Again for land, money. So now out of the 3 lakh or 200,000 crores which was going towards land, as Mr. Pati was also explaining, if you look at all the 10-15 funds together, how much money we have? Not more than 15-20,000 crores. How are we going to fund that 2.5 lakhs? So today, demand far outstrips supply. As I was telling, we don't have any problems of getting business today. We have all term sheets signed and enough demand out there. But the money is an issue. Today, if we were talking about both, let's look at domestic and international. Because of our, whether it is the the past of 2006-7 when Press Note 2 came to 2008, GFC happened. All the international funds, there were about 30-35 hours, part of one of them, burned their hands very badly in India. So even now, today, most of, whether it is domestic or international, they don't want to do pure equity in India. Most of the large fund intakes which happen, whether it is Spain or US, a large part of is again in the commercial, because those are done by sovereign companies,
Yeah,
those are, or the funds, teachers association to pension funds, etc. Now today, let's look at a very common sense out here. Your yield income on commercial is between 8 to 9%. Your LRD rate is 8 to 9%. So where is the arbitrage available? Whereas if you go to a matured Western countries out there, or let's look at our neighbor Dubai out there, you get a yield of 8-9%. Once you have done a bit, you can borrow at around 4.5 to 5% on that, 5.5%. So you are able to create an arbitrage. That arbitrage is missing out there still in India because of the rate. Same thing in residential again. In residential, if you look at it, we are borrowing at that rate, residential yield. Bangalore is probably very good at probably 2.5%, 3%. Bombay is probably between 1 to 2%. So, facing our famous guy who said not to buy a home and finally bought, financially, lot of time it doesn't make sense. So it is a real challenge today to raise funds because the equity market has been doing well. We have enough business, but there is a challenge on raising funds. As you said, if you have a very long track record with the same kind of people, the percentage which will come towards the debt side may be low because they may be doing an equity. But as a diversion, as a safety net, they will still be putting money into the debt platforms and their tried and tested people. But overall, the market was down, and then little clarification, Adani is 20% up. So the market is saying, boss, it's not going anywhere. We are doing very well. It's just, it's not the valley, it's just small dips, and it is going to take us higher. So with that, and, with debt platforms, what most of us do, and we were having a fight between 20% and 12.5% long-term taxes, whereas in debt, with the same, we are still paying the highest bracket of taxes, even through an AIF fund. So they say we have liquidity benefit. We are getting a CAGR in equity in last 3 years of more than 30-35%. And we have a tax of, you earn a 17-18%, it still goes back to 12-13%. Mutual fund I earn 15%, which is a no-brainer for me. I still have to pay less. So somewhere we need to bring in where, when we are saying that the stock is going out of the far beyond fundamentals, we need to bring in other instruments which creates more debt and more safety nets for even at a retail investor. In AIFs, we have 1 crore limit, but in stock, we have no limits, correct? Anyone is putting the money. So those are the things which has to be addressed. If the real estate demand for land itself has to be taken through AIFs, because banks and NBFCs cannot fund it.
No, fair enough. And actually that itself brings me to the next question. And that is basically what kind of a change, or is there a change at all, that we are noticing in terms of fund thesis as such going forward? Now, of course, like Sudarshan, in SME REITs, you are, of course, focusing on core assets. And I think there is a diktat also that you have to focus on core assets. You sort of cannot get into brownfield. Pati's fund, of course, has been predominantly residential, if I'm not wrong. Navin also is doing the same.
No, so what is going to happen, it is going to go more granular. Mm-hmm. So as you said, now it's not a typical commercial fund or a typical SME REIT, right? They have to do completed assets. They cannot go brownfield. Similarly, in residential again.
But there are hardly any assets. I mean, the core
that will remain always a challenge, quality assets. But again, even in residential now, I think there is going to be a breakdown, right? For example, there are going to be more geographical based, more product based within the residential itself. For example, what we did in the residential itself, we came up with the first theme fund of doing only plotted and last mile funding, primarily focused on plotted, which is not in all India. I'm not saying it's all India fund. I'm not going to do all India. So more granularity, because as the maturity comes, more specialization has to come in, where you will be focusing again for the sake of investors. Now you have a sake of investors who understand Bangalore. They understand plotted has been a traditional product, which good, bad, demonetization, non-demonetization, GST, non-GST, NGT, non-NGT, NBFC breakdown. Plotted has been giving a fantastic product. It has been the highest IRR and quick turnover. So if you look at it last 5 years, ago, I used to hear there used to be a very special class of developers used to do plotted. And all the big guys used to say, ye to barfi cutting hai, ye mera kaam to rahi hai. But today, if you look at it, all grade A developers, all listed players are trying to do plotted in Bangalore, right? Because they understand with the product, cash churning and IRR is equally important. Even a Prestige or a Shobha or a Brigade is doing that. So that has become an asset class of its own. There are more products which are going to evolve. As we are saying, with the digitization, with the new India, what we keep talking about, there are going to be new products. And the funds have to be focused around those. You don't need to tap the entire world which used to be. You don't need to be generic. You're going to take a theme, you're going to take a product, create a pocket around that and do business around that. That is what is going to get the new investors in the place. Talking the same old story, as we said, how many of those, first time I went for the first train, some of the wealth manager told me, Sir, why are you doing a 4-year fund? Everyone has done a 7 to 8-year fund. Why are you doing plotting? Everyone is doing a generic. How many people have returned that money? How many people have been able to do it in time? You can't go generic. You have to take control of the product. You have to have a more focus. You have to have a clear design what you want to do. Generic won't work. You have to go into
fair enough.
specialization. You have to go into granularity of it. That is going to be the new mantra.
Oh, sure. And Anuj, I think since you are, of course, as an investment banker, you are talking to a lot of developers in the market, both here and in Hyderabad and other geographies also. Do you see an emerging trend where they're asking for a certain kind of money and not the other kind of money, or a certain kind of deal and not the other kind of deal, or something which was happening all along is not anymore being asked for?
So yeah, of course, the by any developer, the first ask is how cheap you can get the capital. So that goes without saying. But I think now, if you see the whole, the way the market plays, today the biggest gap, as everybody has already laid out, is at an early stage of a project. Banks and NBFCs have been barred to do land stage funding, and that is when the developer needs the maximum money. Because once the approvals are there, sales are there, the cash flow takes care of it, and then there are banks to support the construction finance. So I think so now it's kind of got bucketed in my view. AIFs, the base is going to go increase, primarily to do a lot of debt, high yield debt funding for the land stage or the early stage. Now within that, what evolution is happening is what Navin was highlighting is within that you can go do a little more of a thematic funds, whether it is geography centric, whether it is product centric or asset class centric, I would say. So we know of funds which are focused only on warehousing projects. Navin is doing something which is more focused on plotting projects. Now, each of those products are designed for a different category of investor pool. When I was hearing all three of them, in my mind, I was already deciphering the market as to, what you are saying is we can't compare it because each one of them are catering a different investor pool. Today, what Sudarshan is doing, that pool of capital is literally creating a new investor base in India, which is having capital, investable capital towards real estate ranging from as low as 10 lakh rupees to maybe 1 crore rupees. They have that much capital only to invest in real estate, but they can't go and buy physical real estate. He has enabled them to buy in a fractional way. So that is a new set of investors which have come into the market to buy that. Now, if you go a little more evolved investor, which I would in my language call it as accredited investors, people who have, let's say, investable pool of say 15, 20, 25 crores. Out of that, I want to invest 2 crores in a real estate debt product, which is giving me with a fair amount of lock-in of say 3 to 5 years kind of a thing. But it gives me double of what my FD would give, because it is also backed by an hard asset. So that return expectation, if I want, I'm ready to do away with my liquidity requirement and invest the capital pool with people like Pati who will generate maybe a gross fund level IRR of up around 20 odd %, but net in the hand would be in the range of 14-15%.
So just to interject there, since you talk to a lot of family offices also.
Yeah, so family offices also, what we do, I'm seeing the evolution in the last 10 years on family office side. Now, very clearly, even in family offices, we are seeing 2 levels. So like the first 2 pools which I said, the third pool is, there are a lot of mid-market family offices whom we serve. These are people with a wealth pool of investable capital pool of anywhere ranging from 100 crore to let's say 1,000, 1,500, 2,000 crore, right? They are the people who would happily allocate, let's say, upwards of 15, 20, 50, 100 crores also towards real estate. They are still okay to come and collaborate and invest with funds like ASK or Kotak's of the world or Motilal's of the world to deploy that capital, because they have still not understood the game of how the real estate investment happens. So they are ready to go with the blind pool and leverage the expertise what Pati and his team offers in the market to generate higher returns. But there is another set of family offices which are people who have very evolved family offices, people who had invested money in real estate fund back in 2007. They have gone through that whole cycle. Some have made money, some have not made money, and they have large sums of pool. Now, when I go to them and say that, okay, would you like to invest in a blind pool with a fund? They say, I'm not very keen. What I'm keen is I will put, let's say, 10 crores in a blind pool, but you show me co-investment opportunities with the fund of 100 crores. I'm ready to put 100 crores, but I'm ready to take that extra risk of investing directly with the developers, right? And just to create that alpha. Because if he puts to the blind pool of the fund, his net return would be still in the range of, say, about 14-15% IRR, right? But they see that if I'm able to invest directly with the developer, my net return could be in the range of 20% odd, because they are technically lending or investing at projects at the IRRs of 22%, 24% also.
Is this such a big arbitrage that you're willing to, sort of capture, that you are willing to forego a fund manager's insight into
No. It is, to be very frank with you, it is, it's not that it is very advisable. But they do it, first of all, only with select set of people where they have that comfort of delivery and track record. But I think that that expectation is not coming in purely from a high return. It is coming in from that I don't want to lock in my capital for 5 years. So basically what they are doing is they are churning these deals fast. They are investing at an early stage with the developer with the understanding of getting that money back in the matter of maybe 15 months, 18 months or 12 months. So it's high credit, this thing. Like I was telling somebody just yesterday that as a boutique firm like ours, a very, very small setup, we in the last 3 years directly from family offices to real estate developers, we have done transactions worth 950 crores. So there is that pool of capital which is available in the market, but they will only work with certain set of, and that cannot be open to every developer. They will only work with some very smart developers with a development track record. So you people like us have to operate like a fund. I don't have a fund of my own, but I have 40 family offices which I can, get to the table to the developer and who are ready to do this.
Understood.
So there the IRR expectation would be very different. So there is a risk attached to it.
Another angle to it, which since we handle quite a few family offices, rather large clients, let's qualify somebody who's putting 25 crores and above or 50 crores and above. There are two ways in which we have started handling them to improve their yield play. The first way what we do them is that if they put in say 25 crore to the fund, we give them 25 crore of co-investment opportunity. So how does it work is, they commit 50 crore to the fund. And 25 crore will go as a, say for example, I invest in 10 projects. The 25 crore will be, which they are giving it to the fund, will be invested in as a part of the blind pool, it will go. The balance 25 crores what is committed to me as co-investment opportunity, when this investment is coming up, has come up for investment, I take that particular investment to them and say that this is a play of 250 crores in this particular market. This is the contours of the deal. This is a developer. You have committed 25 crores to me. I am willing to give you, out of 25 crores, you can put up to 5 crores in this investment. Are you prepared to take it? Because for that, my commercials are completely different. So he gets a transaction virtually at a very lower cost so that his average yield improves. The second way, what we have started doing is, which is a very few phenomenon, the new phenomenon, and which is actually leverage play. If somebody commits me say 25 crores, I tell them that you put 15 crores, the balance 10 crores will be funded by me. I'll do an alignment with a NBFC who will fund that 10 crore. So the 15 crore, if it is generating say 15% return, and for the balance 10 crore is has to pay say 10.5%. So 4.5% of arbitrage is available for him on 25 crores, which improves his yield play. So these are some of the things which is emerging, but these are to be done very selectively, because when you commit co-investments and they don't give the commitment, then your term sheet goes for a toss. Similarly, you give a loan through your NBFC and they default because the fund is not distributing the, or fund is delaying the investments, then your NBFC book is under stress. This will emerge, but this is already coming, but I think this will get refined better and better.
Sure. I think our time is about to get over, but I'd like to have one more question and maybe have Sudarshan address that and anybody else on the panel. Since we are in Bangalore and Bangalore is a startup hub, right? A technology hub. Where do you see the areas of technology helping out in real estate finance? Some of the emerging products that we see, of course, one is, of course, Sudarshan's product, where he's already doing it. But is there something else that is coming out which can help, proliferate or rather increase the deployment from the perspective of a developer or an investor? Do you see any kind of innovation which is really coming out in the market right now?
For financing, so one is us, where once it's completed, you could always partner and we can help you financialize your real estate in some sense. And maybe with time, as SEBI relaxes bunch of rules as the sector evolves, I think all other asset classes can also come in, whether it's school, hospitals, etc. So you're talking about a different set of capital or a different set of asset class which investors wanted to take exposure they'll start getting access to, number one. Now from Strata standpoint, right? Now you said you could only buy core assets, right? We don't look at that way at all. While the regulator might say I might not do, but I can always partner with the gentleman here and say, you know what, here is an opportunity, why don't you fund and I exit that opportunity and I buy you out on completion.
They warehouse it for you.
They warehouse it for me, take the risk, obviously they get the alpha in return. We've inked at least 7 to 8 partnerships in the last 3 months saying that, okay, we have this pool of capital wanting to buy core assets, you have your pool of capital wanting to exit. Who wants to take an exit and take that development risk as well. You put your guardrails, I'll put my guardrails with respect to it, and let's enter into a forward purchase today. And that's something which we are doing now. So
that's very interesting from the point of view of the developer community.
A developer has 2 sets of investor base, right? One who says, I want to own it. One who wants to exit, right? Who wants to invest and keep flipping and keep making more and more by keep backing you. Like Prestiges of the world have had those investors who've been backing them for 30 years, right? They just keep investing in every project of theirs. Massive compounder what Prestige has done for these capital pools. So that is the approach which we are trying to saying that let's have a partnership. I can't do it, you can, and I'm your exit provider, right? I want to buy these core assets because I have a different pool of capital. Maybe their same investor pool has a different wallet share who wants to buy these core completed assets on completion, but their fund does not provide them that option because they have to exit because that's the fund mandate, right?
Correct.
So that is one. Second, the emergence of OBPP platform, which, Navin is an advisor to one of them, one of the largest rather, is a very large pool, I feel, over a period of time because it's a quasi-AIF in some sense where you get
For the interest of the audience, could you
So OBPP stands for Online Bond Broking Platforms. This is if in case any developer wants to raise NCDs, you could go and raise listed NCDs via these tech platforms. It's very early stage right now, but in the next 5 years, you could see these platforms becoming monster in terms of its size and ability and attract a pool of capital which was not available. I think SEBI has brought down ticket size down to 1 lakh if I'm not wrong, or maybe 10,000 rupees if I'm not wrong.
They're coming up with new.
They're coming up with new, making it more retailization in some sense where even small retail investors can get access to it. So that's another pool of capital which can be cheaper than the existing pool which is upwards of 20%, can be at 15 to 18% in between that. But an investor, like what he said, everybody wants to co-invest model as well. They're like, screw the co-invest, you directly invest, no problem at all, right? And we can continue running the same fund mandate, fee structure, etc. So, and your exposure is linked to that specific investment rather than the pool of investments which you've done, which is ideally, in my view, better for the fund manager. That even if 5 deals have done well, 1 doesn't do well, the fund manager's 5 years of effort is gone because he's not making any fee, but here he's going to make his fee irrespectively, right? And giving the complete control in the hands of the investor to take a decision, which investor and give all sorts of transparency to them, progress, what's happening, and give
it's
a very
listed and tradable.
Yeah, give an institutional experience to retail investors, even if he's put 10,000 bucks for that matter. I don't see why he should not get access to information. It's his money, he should have all the rights to get.
And probably it will create a big secondary market also. I mean, your
So
product
that is
and
what
your
we-
product
that
also.
is what is happening. So we have we have two platforms called Giraffe and Allgraph. Giraffe is more for listed and Allgraph for unlisted products. So the whole change which is happening in Indian financing is, it is, if you look at a typical middle class or upper middle class, and they want to put into debt, they want to have secured products. So what were the options traditionally? You had current account, which was probably negative. You had a saving account giving you between 2 to 5%, FD between 6 to 7%, liquid funds between 7 to 8%. Then you move into the corporate bonds, which give you between 9 to 10.5%. They are rated, but a lot of time they are unsecured. Most of us don't understand, but they look at the rating, but they don't understand. They're secured, or sometimes they are unsecured. Over and above that, if you want to move, you're stuck. What are your next options? You move into SIP or equity market. You little more restricting, you go into the equity market, you're a little more greedy, naive, whatever you want to call it, you give money to your chacha, mama, dost, and it never comes back. The entire Western structured debt instruments, which was giving you a mid to high teens, a 12 to 15, 17%, much higher than your inflation rate, is basically not available to a middle to upper middle class. That is, I would not use the word monopolized, but cartelized between private equity funds, NBFCs, ultra HNI, family offices, which have the capability to cut between, let's say, a 10, 15 to 100 crore checks. So the whole idea, we brought it sector agnostic, but also applicable to real estate. What we have done is we got the platforms where, we have people like Axel and other very high institutions which have put money at the equity. We are doing, under that platform, we are doing that same 20, 30, 40 crore transaction, which a typical NBFC will do, whether real estate or non-real estate. We have done almost more than 600 crores in real estate and exited close to 400 crores. But what we are doing again there is, we are doing those transactions at about 20, 25 crores, doing under NCDs, and the same middle class guy, which couldn't have exceeded, let's say you have done for Vaishnavi builders, he's getting that 14, 15% fully secured by putting that 1 lakh rupee, which otherwise it's impossible for him to do. So it is a kind of a pseudo AIF which is happening. It is that will get reformed over a period of time. SEBI
But
will
it's
play
reaching a lot of
part.
people because of
Yeah,
technology.
SEBI will play a very important part because it is again experimental and they are very cautious about getting retail customers. But that is the new India. They are putting into a lot more alternate where they can earn that higher return and not stick to FD. So and that is applicable today to real estate. Strata is a form of commercial or Strata. Similarly, in liquid, they are doing it.
Sure.
I'll just add one point, and I know we are running out of time, so I'll just take one point. In one of the regulators' meeting, very interesting insight and a stat which they said that I think India has about 1,300 to 1,500 AIFs, which manage about 4.5 lakh, 5 lakh crores as such, and there are a handful of REIT InvITs which manage 5 lakh crores. So the market depth is significant in the REIT InvIT world as well, where there can be so much which could be done. One of the key parts, and that's when as industry we come together and figure out how can we, you said there are hardly any core assets because people don't want to sell, etc. But then they would love to find...
Not sell, I think they're still not making them enough.
Making them, plus they don't want to sell also. Most of them are like, we're contented, we don't want to sell. That's where financialization comes. Today the regulations, at least in our SM REIT, it says 25-75. You can still retain 25. You have to sell 75%. I don't know why. It should be 75-25. Like when you're IPOing a company, promoters can retain 75% and they can only divest. How is real estate more different? IPO, I mean, in a company, it's even more because you have no control over the company. In a property,
this is a question for the answer for which you only will tell us.
No, I'm saying these are things when relaxation happens. All those assets which are there will financialize in a large way. You'll still control, you'll still have 75%, but the 25% gave you a liquidity window.
Sure.
You are now listed on the exchange. You can take money as an OD rather than LRDs or everything which you have to take, which is a long drawn process, cumbersome. I'm sure every developer would tell it's difficult dealing with banks, but it becomes much simpler when it's listed on the exchange and unit sitting in your demat account. Great for inheritance. You have a professional manager managing it. You may be doing 2 or 3 developments in a year. Your professional manager is doing 30, 40 projects a year. So ability to lease, ability to asset management, ability to do bunch of other things is like adding another layer of partnership to somebody when they look at partnering on an SM REIT platform, right? So SM REIT is one, NCD is another structure through OBPP, maybe more what all will come. SDI is a new product which is coming up, securitized debt instrument which is now also listed on the exchange. So bunch of these things will keep innovating.
So exciting times ahead.
Exciting.
No, awesome, awesome. I wish we had more time. We had many more questions. But I'll open up to the audience, I guess, if any questions.
We actually are running delayed,
Running out
sir.
of
So
time.
I'll request all of you to please kindly connect with these stalwarts offline. I know it's one of a kind opportunity, but in the best interest of time, we actually have to move forward. So please give them a huge round of applause, ladies and gentlemen. Any questions and queries, which I'm sure are there in plenty, please feel free to connect with them offline. I'll request Akshata Hegre, Product Manager from Vox Interior and Exterior Solutions Private Limited, to kindly join me over here on stage and hand over the token of appreciations to all of them. Once again, a huge round of applause for her as well, please, ladies and gentlemen. Thank you so much. Requesting all of you to please kindly come forward for a group photo. Thank you. Can we have some clapping over here in this room? Thank you so much. Like sir said, even we wanted more time, but then unfortunately, I mean, there are other sessions that need to be followed. So please feel free to connect with them offline. And thank you so much to all of you once again for your valued time and presence. Thank you.